boom. There's no way that taxes don't go through the roof when that happens. And regulations, because they will try to regulate their way out of these disasters, and that won't work either. So, that's one of the slippery slopes that we're on right now, that will make even well-run states badly run in the future. And, it's not clear where we go. And that could be enough to slow the economy down to tip us into recession in the next year. And we're so financially fragile because we've been borrowing so much money over the past 15 or so years to get us out of the Great Recession, that a garden variety recession could easily metastasize into something much more dangerous. So,
in today's episode, John Rubino, a seasoned financial analyst and commentator, has long warned about the fragility of the U.S. economy under its growing mountain of debt. In his latest analysis, he points to the real estate market as the likely catalyst for a potential recession in 2025. With interest rates remaining elevated and household debt at record levels, the housing sector is under immense strain. Mortgage affordability has plummeted, pushing many would-be buyers out of the market and leaving sellers with little room to maneuver. Rubino argues that the slowdown in real estate activity, coupled with tighter lending conditions, could trigger a domino effect across the broader economy as construction jobs dwindle and consumer spending weakens. Compounding the problem is the ballooning corporate and government debt, which Rubino notes leaves little fiscal or monetary wiggle room to cushion the blow. Commercial real estate in particular stands as a ticking time bomb, with vacancies soaring in major cities and refinancing challenges mounting for over-leveraged property owners. This dynamic, Rubino suggests, could mirror the financial crisis of 2008, albeit with broader implications given today's elevated debt levels. If policymakers fail to address these structural vulnerabilities, he cautions, the U.S. economy risks a deep and prolonged downturn, driven by a sector that once symbolized stability and prosperity. Now, we'll show you the best clips from the latest interview, but first, like, subscribe, and turn on notifications so you don't miss our daily recaps. Also, check out our NordVPN deal. It's the fastest and most reliable VPN on the market. If you're a stacker, this is a perfect fit for you because safeguarding your internet data from government surveillance will be crucial moving forward. Check the link in the pinned comment and get 3 free months today. Enjoy the episode.
We've been debasing the currency via excessively easy monetary policy. And that makes financial asset prices go up. And houses are basically financial assets because you borrow money to buy them in most cases. So home prices have been soaring at the same time that more and more people are moving into these dangerous places. And that puts the insurance companies in a big bind because they're on the hook for replacing these multi-million-dollar houses when they burn down, or whether they're destroyed by a hurricane or whatever, which means they have to raise their premiums. And things are getting so bad now. And I should say, it's not because of climate change. It's not because any of these things are becoming more and more frequent necessarily. It's because people are moving into these places, which magnifies the danger and the cost of these recurring natural disasters. So yeah, the chart we have up now shows Miami's home prices. And you see that I'm eyeballing it, but it looks like they're about twice as high as they were at the peak of the real estate bubble in the 2000s. So you've got a massive amount of extremely expensive real estate right there, just waiting to be impaired and or destroyed by the next big hurricane. And with what's going on in Los Angeles right now, it's brutal. They've got high winds, which are spreading fires. I'm not sure anything is still burning now, but they've been burning for the last couple of weeks. And they've got a record number of houses that have burned down. And it's not just, one category of house. It's Pacific Palisades, which are extremely high priced, and other places which are more modest. They're all, they all burned down in the fires that just happened. And so what's happening with the insurance companies is that they're either raising their rates for homeowners insurance on both coasts to a level at which they can make money insuring all these incredibly expensive houses in places with frequent natural disasters, or they're just pulling out of those markets altogether. So they're leaving homeowners with a big problem in a lot of cases, where even if they can get homeowners insurance, it's so expensive that it's debilitating. They can't keep their house if they insure their house, or they can't get insurance at all, which means a lot of houses are uninsurable and therefore unsellable. And we're talking tens of thousands, if not hundreds of thousands of people on both coasts who are in this kind of a position where they've got extremely expensive real estate that they can't insure. And so if they want to get out of it, they can't sell it. But if they stay in it, they're on the hook for the whole price of the thing when the next natural disaster destroys it. Now, with all of that happening, you get something called the reverse wealth effect, which is the wealth effect is basically the process by which when our stocks go up, we feel rich and smart, and we're more likely to take a nice vacation or buy a Tesla or whatever, and that stimulates the economy. But the reverse happens when we feel poor and stupid, which is the way a growing number of homeowners on the coasts feel right now. And they, therefore, are a lot less likely to spend the way they would have otherwise, because they've got this giant gaping financial hole in their lives in the form of their house. And that could be enough to slow the economy down to tip us into recession in the next year. And we're so financially fragile because we've been borrowing so much money over the past 15 or so years to get us out of the Great Recession that a garden variety recession could easily metastasize into something much more dangerous. So it could well be that homeowners insurance is the catalyst that pushes us into a recession that then turns into something worse than the Great Recession of the previous decade. And who would have thought that homeowners insurance would be the catalyst? Because there are so many other things that seem more pressing, like us drifting into World War III, or inflation remaining ahead of the Fed's target range, forcing interest rates up. Those things seem like the more logical catalysts. But now, after the LA fires, it's completely possible that homeowners insurance in particular and real estate in general turn out to be the thing that pushes us into the next recession.
In today's news recap, gold prices see some profit taking, but hold the line above 2,700 as housing starts rises 15.8% in December. Gold is facing some selling pressure, but remains above $2,700 an ounce, even as the U.S. housing market shows signs of stabilizing with improved housing construction activity in December. Housing starts jumped nearly 15% last month to a seasonally adjusted annual rate of 1.499 million units, up from November's reading of 1.294 million units, the Commerce Department announced on Friday. The data significantly exceeded expectations, as economists had forecast a slight increase to 1.33 million units. Despite the monthly increase, the report noted that housing activity is still down 4.4% compared to December 2023. Better than expected construction data is adding pressure to gold, which is already experiencing some profit taking after prices hit a 2-month high on Thursday. Spot gold last traded at $2,705.90 an ounce, down 0.32% on the day. Technical analysts will monitor whether the $2,700 level holds as support. This level has acted as solid resistance, with prices consolidating in a narrow range over the past 3 months. Economists are closely monitoring the U.S. housing sector due to its significant impact on GDP. The sector has struggled as consumers have been priced out of the market. Higher interest rates have pushed mortgage rates higher, while low inventories have kept prices elevated. Some economists expect the housing market to continue facing challenges as the Federal Reserve looks to shorten its easing cycle through 2025. Markets are currently pricing pricing in one 25 basis point cut this year. Now, we'll show you the best clips from the latest interview. But first, like, subscribe, and turn on notifications so you don't miss our daily recaps. Also, check out our NordVPN deal. It's the fastest and most reliable VPN on the market. If you're a stacker, this is a perfect fit for you because safeguarding your internet data from government surveillance will be crucial moving forward. For a small cash outlay, you can ensure you're protected from prying eyes. Check the link in the pinned comment and get 3 free months today. Enjoy the episode.
A big part of the real estate story, because we basically we came down on a side in those riots, and it was the side of the rioters, which is to say the side that is opposed to small businesses in a lot of towns. And insurance companies are watching this, and they know that there's always something going on that could lead to civil unrest in the U.S. We're a deeply divided society, in which a handful of people have most of the wealth, and the vast majority of other people are frustrated, and so they can take to the streets at any time for many different reasons. And if you're trying to insure a small business that's at street level, for instance, your policy has got to be becoming more expensive, right? Because the insurance companies, they're looking at this and they're thinking, wow, okay, what happens when there's the next police shooting, or the next contested election, or the next war where body bags start coming back and people don't want to accept it? And there are lots of reasons for people to hit the streets. And the government has shown itself to be unwilling to protect property at the expense of the rioters. So yeah, that's another thing that makes it hard to manage a business and manage property and insure it in a way that it's profitable. Unless you have ironclad guarantees of protection and insurance and manageable prices going forward, capitalism doesn't work. You need certain kinds of certainty in order to convince entrepreneurs to put themselves on the line and put their capital on the line to start businesses and run businesses that won't be profitable at first and that have to be profitable eventually if you want to keep them. And inflation is devastating for that whole concept of future certainty of income streams. But civil unrest is a big deal too, and natural disasters are a big deal. And we're handling all of it so badly that you put it all together, and what we would like to think of as a free market society based on private property and individual choice just doesn't work anymore. So that is a broader, longer term critique of what's going on out there. But it's a real one. Things are getting worse instead of better from the point of view of entrepreneurs. And if those guys shut down, job growth stops. And then you have a society that just doesn't work at all. If we don't have a robust jobs market, we have a chaotic political system. And if we have a chaotic political system, we have a broken financial system at the upper levels. And it all feeds into basically the same process of us getting worse and worse at doing important things. We're losing confidence in our ability to create wealth. For a lot of different reasons. But it all points towards an economy that doesn't work, doesn't generate enough tax revenue, doesn't generate enough personal income, doesn't generate enough capital flowing into the financial markets. And so, to put it in a very general sense, we're starting to look like Europe. Europe is a mess because they made some very fundamental mistakes, different mistakes for each country, but all accumulating in a sense that the EU might not even be able to hold together going forward. And, sometimes in the U.S. we're smug about us being better run than lots of other countries, but that's not always the case, and it's increasingly not the case at all that we're well run. So,
what do you think about John Rubino's take on the real estate market as a potential recession trigger in 2025? Do you see housing debt and elevated interest rates as the tipping point, or is there another factor you believe could drive the next downturn? Share your thoughts in the comments below. We'd love to hear your perspective. Now watch this video right here because it's a perfect fit for you. I'll see you on the other side.